Money Talks Media, welcome back. We've got our good friend Mike Evans, Senior Vice President, Mackenzie Financial. Today we're talking RSP talk, where to invest. We just had a very nice discussion about corporate bonds, notching up the ladder in terms of risk. So Mike, people, if they want to take a little step, a little bit outside of the fixed income, what's their next opportunity in terms of risk, just increasing the notch up? Going up one or two more notches.
Great question, John. Well, first and foremost, you reminded me another thought I wanted to interject. The best way for retail investors to minimize risk, to maximize return, and take away a lot of volatility is as simple as the strategy developed for putting money in, dollar cost averaging, investing by installment, systematic purchasing. We found those investors that were committed to a systematic purchasing plan, monthly deposit, throughout the downturn did far better than those who attempted to time the market. Because of course, people never want to buy at market bottoms, but those are always opportunistic for those that are willing to make the purchase. The problem is your emotions get in the way.
Right.
So I know you're a big proponent of dollar cost averaging, investing by installment, contributing on that basis. Also makes it much easier for investors to come up with the money to make their RSP contribution. Did you want to highlight amounts of contribution, deadlines, when they need to act by, any and all of those things, or we're going to sum that up at the end?
I think we sum that up at the end, but you know, it is end of January, and everyone's got till March 1st to make those contributions, and they're allowed up to 18% of their income to maximum, I believe, 22,000 on their RSP limits, and you know, there's no foreign content restrictions anymore like there used to be. So I mean, just some rules overall. You know, what you can actually do is on our website, go to Northwood Mortgage Life and request, you know, the RSP rules, and we'll send those to you. Because it's very easy to do, and fortunately we've got good friends at Mackenzie who keep us well informed on that regard. Go ahead.
I also encourage your listeners to have a good hard look at their notice of assessment from CCRA. Have a look at their contribution room for this year. Have a look at their carry forward amounts, how much they can contribute to their plans. Talk to you about putting together a strategy to make sure they maximize those positions.
Absolutely.
Now, we spoke about corporate bonds and conservative fixed income and ways that clients can mitigate market volatility. What we're starting to see now, after 2 years of economic recovery, is clients with a desire to more fully participate in economic advance, in the economy in repair.
So where do we send these people? I mean, they've been sitting on the sidelines. They're going, you know what? I got killed in 2008. I saw my portfolio go down dramatically. I'm not sure want to go into full equities, but I want to at least get a little out of this fixed income, low rates of return. Go ahead.
The natural response is balanced funds, and you know, the industry has a number of wonderfully constructed balanced products. We at Mackenzie have several that we're extremely positive on, and two that I think are worthy of mention on the Mackenzie lineup would be our Mackenzie Strategic Income Fund, run by Dan Pastasic. Dan's also the manager of the corporate bond fund that we've spoke of many times during the economic downturn. Did tremendously well there. His Strategic Income Fund is the next step up the chain.
And why is that?
It's a balanced fund. It has an ability to own both fixed income, corporate bonds in this case, and income-oriented equity. So it's a wonderful blend of defensive companies, well-managed, strong earnings, low debt, and an ability to create a consistent cash flow. So on the fixed income side, focusing primarily on corporate bonds, the likes of which we discussed in the last show, and equity, income-oriented equity.
Like dividend distributions?
Like infrastructure, so pipelines, utilities, toll roads, companies with strong incomes, REITs, and the income trust market. Now, we know that taxation changes have occurred to income trusts. Some companies have converted back to corporations, some have remained as trusts, but net the benefit tax-wise is all the same. So REITs and trusts have been a big part, and then high dividend yielding common shares, preferreds, convertibles, income-oriented equity, and focusing on companies with strong earnings, a long and consistent history of distributing those earnings to unit holders. And that's exactly what we're focused on.
And what can people expect? What sort of rates of return can people expect from these types of investments?
Well, as you know, we don't want to necessarily predict returns. That's a little foul in our business. But I can tell you this, Dan's registered strategic income fund did 14.22% net of all fees last year, making it the #1 Canadian equity neutral balanced fund in its category.
Fantastic.
Now, compare that with the 3% yield on the 10-year Treasury.
Right.
There's a manager that makes a lot of sense. And I'll add this, John. Another thing I like about Dan's fund is its ability to respond to market circumstances. It's not locked into a 60-40, 70-30 equity to fixed income mix. It really has the ability to respond to market circumstances. Could be 80% fixed income or 80% equity, depending on Dan's assessment of both opportunities and risks in the market. So it's a fund designed to keep people invested, to reduce volatility. Secondly, to provide yield. And third, to provide growth.
What's his split right now?
Right now, he's 25% corporate bonds, I think almost 15% in cash. So he's been building a little cash. We've had a nice run in the market in the last quarter of 2010. So Dan's got a little on the sidelines, waiting for opportunities. And the remainder is in income-oriented equities, split between the infrastructure, the REIT and income trust, as well as high dividend yielding common shares.
And in terms of risk, it doesn't have the same risk as a pure equity fund.
No, the balanced process, in fact, the #1 selling category of investment for Canadians has been Canadian balanced funds. Reason #1, lower volatility, right? You're taking away the ups and downs, adding greater stability, and achieving virtually the same outcome you would with full equity.
Excellent. Okay.
Now, I'll mention one additional comment on the fund. Like the corporate bond fund, the fund we spoke about last, strategic income comes in both a capital class for open money and a regular version. So in registered plans where you're sheltered from taxation and tax isn't a big concern, you can buy the regular strategic income fund. For those of you investing in open money, we have a class version of the fund that would allow you to participate in deferring taxation, minimizing tax, and focusing on deferral or capital gain income.
Excellent. Okay. Anything else you want to say about strategic income balanced funds before we sort of dig down and talk equities?
Strategic income and or the Saxon balanced fund would be our primary balanced fund recommendations for the coming year. Two solid funds, great returns, long history, and terrific performance for investors.
Excellent. We're going to take a quick 2-minute break. We're going to come back and talk equities with our good friend Mike Evans, Senior Vice President, Mackenzie Financial. Take it away, Blue.